Hey, David Raffoff here. Hope you're having a good day. In this video, I want to run through a financial planning tool that I made and just a common scenario that I built the tool to kind of answer. And it's like a common question most people have when they've got some extra money left over and they want to figure out what to do with it at the end of the month. Um, so, a common scenario that people are in is they have a house and they also are like saving for retirement, and they're trying to figure out if they should use the extra money that they have left over either for paying off their house early or for kind of maximizing their retirement. And what's interesting about that question is there's multiple facets to it. So there is the mathematical part of it, which just is what's the maximum net worth you could have after a certain period of time, depending on what you do. But then there's also a risk and comfort factor as well. So you may be very interested in paying off your house early for specific reasons, like maybe your income's unstable, maybe you think you might not want to work after a certain amount of time and you want to feel safe doing that. Or maybe you just overall don't trust that the stock market's going to continue to have the same kind of returns that it's had in the past, or you're worried about volatility or whatever it is. There's a bunch of reasons for it. And there's really kind of different camps, major camps on how to prioritize this. So if you listen to like Dave Ramsey, for example, he really encourages people to shorten their mortgages from 30 years to 15 years and just get them paid off. But it more or less comes down to how much risk you're willing to take. So anyway, this tool, one thing that's nice about it is it makes it very easy to compare these different scenarios and kind of show you what the extremes are, and then if you want to like go with one of those extremes, that's great. And if you don't, maybe you want to land somewhere in the middle. You can run that scenario too and kind of see what you would end up with. So I'm not going to go super deep into the numbers here just for the sake of time, but the rough scenario here is you've got a $300,000 house, you have a $250,000 mortgage on it at 5%, and you have income and expenses and investments, and those expenses include things like paying for your mortgage, your property taxes, and homeowners insurance, and then all your other expenses you would have. And then in the investments bucket, there's two different investments that I have set up. So one is going to be taking part of your income and putting $100 a month towards a 401k for investment. And then the other one is money that you're spending towards your principal and interest. There's a reason I have them lumped together, but just know by doing that, it essentially makes sure that your mortgage is going to get paid off in 30 years under this scenario. That's the only thing that's important. Um, and then in this scenario, you have $5,000 of income and then a combined expenses and investments of $4,000 a month. So that means you've got an extra $1,000 a month left over, and you want to figure out what's the best way to use that money. Really common question. So what we can look at here just quickly, all these lines over here represent these assets on the left and how they change over time. And the one that sticks up way above the other ones is the total, is the net worth line, essentially. You might be wondering why it's low here at first. That's because it has to take into account both owning the asset of your home and then also owning the mortgage on that. So that's going to pull that down. But anyway, in this scenario, at the end of 30 years, the projected net worth here is roughly $1.1 million, and that's including the value of the home at the time. So if you were to invest, if you were interested in taking all of that money, extra money you had, and just trying to pay off your mortgage as quickly as possible, what you could do with this tool is you could just go in and you could say, I'm going to add $1,000 a month towards my mortgage. You can see here it's coming out of cash, which is where all the income goes, and then taking that money and putting it towards the mortgage. And what you see here when we do that is at about year 11, it's a little later, let's just say year 12 to be safe, you've paid off the mortgage balance. There's no, your down to zero on the mortgage balance. So not in the negative anymore there. And what that tells you is you can also change, instead of paying from month zero to the final month of 30 years, you just want to pay 12 years and 12 months each. So that's 144. And then at that point, that extra money is basically just going to stay in cash in this scenario. And if you do that, so this is basically refusing to add more investment to your 401k, but paying off your house early. If you did that, at the end of the 30 years, you would end up with about a little less, but about 1.3 million. So you can see that's an improvement. I mean, maybe it's an extra 150 or $60,000 in your net worth, and you've got your house paid off early, and you're being very conservative. You've paid off the house. You're keeping a lot of money in cash. Still putting a little bit in the stock market in an investment account, but not a lot. And then, it's pretty decent at the end of it. You've got about 1.3 million, and you've increased your net worth by roughly 150,000. So that's a pretty cool scenario. And it's got to be a great feeling to, in 12 years, basically have your house completely paid off. But now you could compare that also to kind of the other extreme, which would be just paying what you're originally going to pay for your mortgage to get it paid off in 30 years. And then instead investing that extra $1,000 a month into your 401k. So just add an extra 1,000 there. And you can see this is going from cash to the 401k from month 0 to month 360. So for 30 years. And in this scenario, you can see really quickly, just because the rate of return is so much higher on the stock market, which is what I'm assuming this is going to get invested in that 401k, you can see that the value really starts to benefit from the compounding effect of the interest over time, and you start to get this slight kind of like exponential curve up. And you can tell too, this is the total line up here. You can see around, year 20 essentially. You're kind of getting up, or maybe it's year 21. You're getting up to roughly the same total net worth you were seeing at year 30. So if you say this was your target, like roughly 1.2 or 1.3 million dollars for retirement, what that means is if you were to invest this money in your 401k instead, you could potentially retire 9 years earlier, or whatever it is, 9 or 10 years earlier. And then if we want to look at the final number here, we can see if we were to just keep going for the full 30 years, that we would end up a lot closer to $3 million, 2.8 and a half roughly. And again, the house is going to get paid off in year 30. So just from a mathematical modeling standpoint, this is a much superior strategy for total net worth. But again, you have to factor in risk. So, is this a strategy you can stick with for the full 30 years? Are you going to stay in when the stock market has huge swings up and down and just consistently do this every month? That's a question you have to honestly answer. There's a lot of built-in assumptions, like I said, just because that's what the stock market's done in the past over a certain period is no guarantee that's what it's going to do in the future. It seems likely it will do something like that, but it probably won't be exactly the same thing. And then there's some other really important issues like timing. So, you may just totally knock this thing out of the park. It may do even better than what's projected here. But say, you got up to this point, and for whatever reason, the stock market dropped 50%. That's a thing that can happen. It's happened in the past. Where you could get really messed up in this scenario is, you did really well with your investments, but then they drop. And then maybe, you just have really bad luck. And for some reason, you have some big event in your life as well, and you need to do something about it. Maybe that's, big medical bills. Maybe there's somebody in your family that lost their house or whatever it is. Maybe there's some just large event that you need to take care of. So there's always a risk that you'll be forced to pull your money out of the stock market when it's kind of the worst time. So the risk is maybe a little lower with something like a 401k or an IRA, where there's a big disincentive for you to do things like pull money out, but things happen, right? So what's interesting with this tool is it just shows you what these different scenarios could look like, and then you can kind of make your own decisions with that knowledge based off of if you want to go all the way to one extreme or all the way to the other extreme, or you could even come back here and say you wanted to run the numbers for doing something kind of down the middle, where maybe you try to pay off your house in like 15 years instead, and invest in the stock market with some of the money, and then once you've paid off your house, use all that money towards investing in the stock market. So you can run all those scenarios with this tool. This is still pretty early. I have kind of rebuilt this on the engineering side using a set of tools that's better suited to doing this, but I've kind of gotten back to having the same feature set that I had previously. So now I'm really looking forward to moving forward and trying to make this easier to use, put in some more safeguards, put in some common scenarios. A scenario I'll run through in another video probably is doing things like trying to use real numbers for your income and expenses and investments, like while you're working during your career, and then looking at other periods as well. So the simplest one would be if you were going to work until you were 65, retire, and then see how your income and expenses and investments change at that point, because you would maybe no longer have a paycheck, but then also start picking up Social Security. You may have a different set of expenses. Your expenses would be drawing from something besides cash or income. It would probably be coming out of like a 401k or some kind of retirement account. And it can make a big difference where you're pulling that money from. So one thing that this tool's really cool for is you can look at kind of those different periods and see what would actually happen, not just using some generic rule of thumb. Like some people just kind of target a total dollar amount that they want to have for retirement and assume they'll only pull like 4 or 5% off of that over time. And that's a good rule of thumb, but it's also very simplistic. And you may have specific things that you're interested in doing, like say right when you retire, maybe you're going to roughly keep your expenses the same, but maybe you want to make some big purchase, like maybe you want to do a huge vacation or buy your dream car or buy a boat or whatever it is. I mean, maybe you've got just something you've been waiting for most of your life, you kind of want to reward yourself with, and it could be interesting to see like what the actual impact is of making that kind of change. So anyway, I'll run through some more scenarios like that in the future, but yeah, thanks for following along for this one. If you have questions, comments, or suggestions, or like scenarios you'd like to see, let me know in the comments in the video, and I'll try to make that happen. But yeah, thanks for watching, and I'll see you in the next one.